Hi, this is John Kamarianos. Welcome to a new edition of Capital Considered. At the beginning of November 2025, U.S. stocks are expensive. Here's the way we can show that. This is called the CAPE ratio. CAPE stands for the cyclically adjusted PE ratio, sometimes also called the Shiller PE, named after Professor Robert Shiller, Nobel laureate at Yale University. What is this and what does it mean? Well, what is a price to earnings ratio of a stock? It's the price of the stock relative to the most recent, usually 1 year's worth of profits that the underlying business is generating. Remember, when you buy a stock, there's an underlying business attached to it. The stock is an ownership unit of the business. And so you're buying earnings. We don't know what future earnings are going to be. Nobody does, but we know what the last 1 year's worth of earnings is. The CAPE ratio, the cyclically adjusted PE, takes that denominator, the earnings, and it takes the last 10 years and averages it out. So the last 10 years average earnings, and it also inflation adjusts that number. So you get arguably a better reading of whether a company or the stock market as a whole, which this represents, the S&P 500, is overpriced or not. This is not a perfect ratio. There's nothing perfect in finance or investing. You can buy the CAPE ratio. You can buy the stock market when the CAPE ratio is high and do well. Sometimes you can buy it when it's low and not do well sometimes. But most of the time, if you buy it when it's historically high, you will achieve subpar returns for the next decade, not necessarily for the next year, not necessarily for the next 2 years or even 5 years, but usually for the next decade, you achieve poor returns if you buy this when it's high. This blue line represents the CAPE ratio from 1880. It going back to 1870 because of course it is a 10-year average for the earnings. So the average for this whole stretch of time is represented by the yellow dashed or the gold dashed line. It's about 17, a little over 17. So what does that mean? That means over the long stretch of time for which we have data going back to 1880 or 1870, people have paid $17 for a dollar's worth of past 10 years real or inflation adjusted earnings. Real is another word for inflation adjusted. But if you look at this double dashed green line above it, starting in 1990, coming up to the present, you'll see that the average CAPE ratio or Shiller PE is 27. So it's been historically high using all of the history we have since 1990, leading some to believe that we shouldn't use the 17 average anymore, that doesn't mean anything anymore, that the new average is at least 20 or 27 as it shows here since 1990. I'm open to the argument that the 17 is too low. I'm not sure 27 is reasonable. A lot of strange things have happened in the economy since 1990. A lot of the major industries are oligopolies now. This is maybe an argument for another time, but let's stipulate that 25 or 27 is the correct average PE ratio or Shiller PE or CAPE ratio. We're at 39. We are in no way cheap. 39 represented by the red 39.5 in the upper right corner here. You can see two big peaks here before the current CAPE ratio of 39.5. The first one is moving from right to left in 2000, the peak of the tech bubble. We peaked at 44, late 1999, early 2000. Moving more to the left, you can see we peaked in 1929 at around 33. So those are the two peaks of the CAPE ratio. We've already taken out or exceeded the 1929 peak of 33, and it looks like we may take out the 2000 peak of 44. Can the CAPE ratio go to 50, 60? Sure, it can. There's nothing that says it can't. But if you're paying 40 or 50 times $50, 40 or $50 for a dollar's worth of earnings, you are anticipating a lot of earnings growth in the future, or you're setting yourself up for subpar stock market returns or US stock market returns or S&P 500 returns. So, should everyone watching this video change their allocation and sell completely out of US stocks? Probably not. You should keep your allocation steady, but you should be aware of where we are on this metric. You are buying future earnings when you buy stocks. You're buying the future earnings of those underlying companies. Again, we don't know what they'll be, but we know what the past earnings are. Maybe companies like Nvidia, some of the other larger tech companies, Apple, Microsoft, maybe they will grow their earnings dramatically, and it won't be so bad paying $40 for a dollar's worth of past 10-year average earnings. Most of the time, that's not the case. A lot of hope is built into stock prices when they get this high relative to past 10-year earnings. So what can one do, assuming you should keep your allocation steady? The firm in Boston called GMO, Grantham, Mayo, Van Otterloo, has an interesting paper. The first thing this paper says is that a 60/40 portfolio, so 60 stocks, 40 bonds. Since the beginning of the 20th century, there have been 6 periods where the stock market has had at least 7 years of no real returns, no returns relative to inflation. That's kind of alarming when you look at this graphic. And usually those periods have come when the CAPE ratio is very high. So, what is GMO doing to combat this? Four things. One, if you're going to keep your allocation steady, if you're a 60/40 investor or whatever your prearranged stock allocation is, keep it maybe because it's not wise to adjust it upwards or downwards. You never know when to get back to normal. But make some adjustments, such as getting into international stocks a little bit more than you might be. Many U.S. investors, this is true across the world, people have a home country bias. They own the stocks of their home country sort of disproportionately. And that's true for the US as well as it is for other countries. So maybe own some more international stocks. Two, own some deep value stocks. These are stocks that trade with lower PE ratios. They may not be their business quality may not be as high as other stocks that trade with higher PE ratios, but they've been left behind lately. They may be inordinately cheap. Two things that come to mind are oil stocks and REITs. You don't need to buy those stocks specifically, but if you overweight your portfolio to the value side of the market, you'll pick up those stocks. So you can buy an ETF, for example, that owns what are called value stocks. That's GMO's second choice here. Japan, GMO is fond of, as the graphic here shows. Warren Buffett recently has uh, touted 5 Japanese conglomerates that he owns. Um, so GMO has a Japan overweight. And then liquid alternatives. I'm not going to say too much about those right now, but those can be things like long short funds, trend following funds that are complicated. They trade futures contracts. But these are four things that GMO is doing to combat expensive US stocks or to do something else than invest in US stocks or the S&P 500, which looks quite expensive now on its own history. GMO doesn't mention small caps. That might be another thing to do, get some more small cap exposure than you may have already. So don't panic, I would say. Consult with your advisor, but it's important to know that we are, at least on the Shiller PE or CAPE ratio metric, at nosebleed levels right now. Again, it may pan out. The large tech companies have monopoly-like profits, which could justify current valuations, current prices relative to past earnings. But Usually that's not the case. That doesn't happen. Competition often intervenes and disappoints investors when prices get this high. So beware. Don't do anything drastic, but understand where we are now on this important metric. This is John Comarianos for Capital Considered, signing off. Thank you for watching.
No information on this podcast should be construed as investment, tax, or legal advice. This podcast is not an offer for advisory services or to buy or sell securities. Before making any financial decisions, consult with a qualified professional advisor who can assess your individual needs and circumstances. Past performance is not indicative of future results, and all investments carry risks, including the potential loss of principal. Securities discussed in this podcast may be holdings of the host or his clients.